What's going on, Investomaniacs? Your boy Knight Rider here, and today we're going to be talking about JPMorgan Chase, Bank of America, and Wells Fargo. Three of the biggest names in banking all came out on top of their projected earnings for the second quarter, but JPMorgan Chase, Bank of America, and Wells Fargo face uncertainty heading into the rest of 2019, with the Fed expected to cut interest rates as early as the end of July. While cutting interest rates is good for business in general, right? For the United States, it's bad for bank business, as that means they make less interest off of their loans. And that's how banks make a lot of their money. JPMorgan Chase enjoyed a one-time tax boost into larger than expected profits, setting a company revenue record in the first half of 2019. While showing some concern about the potentially impending rate cut, the financial giant is spending more time being excited about a new service they rolled out last week, a so-called robo-investor called U-Invest. Sadly, it's not actually a robo-investor, but an electronic investing service similar to E-Trade or TD Ameritrade. JPMorgan Chase has had the new service in development for the last several years and tested the waters with select markets before opening the service to the general public on July 10th. With a baseline investment of only $2,500, low fees, and the opportunity to invest in the bank's own ETFs, JPMorgan Chase is looking to use the latest technology to get their piece of that $1 trillion industry. While a $2,500 minimum and various fees may seem old school compared to some new brokers like Robinhood, it's very important to remember Robinhood is primarily popular with a whole bunch of broke kids, a bunch of po millennials and Gen Zers or whatever they're called. JP Morgan, on the other hand, they like that old money, that old people money, that I belong to the country club and I'm golfing all day, that type of old white people money, you know what I'm talking about, that old affluent demographic. Having said that, young poor kids eventually grow up. Now, granted, most of them grow up to just be old poor people, but some of them, at least that's the plan, right? We're trying to get there. Some of us will hopefully grow up to one day be filthy, stinking rich, and then we're on that. Well, I don't want to play no golf. That sounds boring, man. That's not fun. I want to retire. I want to work. I want us to make some more monies. Anyway, Robinhood is going to have a significant advantage in retaining those individuals, right? The young guys who grow up to have money because they're already using the Robinhood platform. Robinhood just needs to make sure that over time they continue to build out that platform with more features, as I did have to currently leave the Robinhood platform because I wanted a couple new features. I'm unsure how U-Invest will perform. In many ways, the platform doesn't appear to offer anything all that new, and U-Invest is going to be a little bit late to the game. On the other hand, JPMorgan has a very strong brand name, and they are extremely competent operators. I will wait for the data before I draw a conclusion on U-Invest, but I don't need to wait to give a JP Morgan buy, because I like JP Morgan one way or the other. Over at Bank of America, they also ended the second quarter with record profits, and the bank now claims to service 1 out of every 2 American households. Damn! They have been soaring high on consumer confidence, seeing an increase of deposits by 3% and household loans going up by 6% this year. That's great news for their personal banking business, but they are holding off on making any big moves or big predictions for the remainder of 2019 until they see what the Fed is going to do this month. if the Fed cuts rates, Bank of America will be looking at a smaller profit margin with a wider gap between consumer deposits and loan interest. But they are probably not crying over at Bank of America headquarters just yet, because their corporate and international businesses remain strong and on the rise. Even with the Chinese tariff issues, they're still pumping on all cylinders. They're still going full on, man. Bank of America is running full steam. I like it, and the thing is darn cheap. It is a buy. Up next is Wells Fargo, who also fared quite well in Q2, exceeding expectations, much like its other banking competitors. They too are being cautious about what comes next, with this rate drop dangling like a sword above their heads. Okay, maybe it's a little bit of a stretch. Right? It's not. I mean, they're still going to be good, but it's like a sword dangling above a portion of the mountains of cash that the banks are ranking in, and it's one of the hills. Is one of those hills of all the big old mountains. One of those hills is going to get slashed off, and all that money's going to be gone. One of the biggest problems facing Wells Fargo these days is what to do with all that money there. No. Is what it's looking like the wheels have come off of the iconic stagecoach just a little bit when it comes to finding a new CEO. This is a genuine concern for Wells Fargo. It seems nobody wants to step up and clean up the mess made by former Chief Executive Officer Tim Sloan, who resigned this March. Sloan was at the helm during the 2016 kind of fiasco when the bank was slammed with scrutiny after it was discovered how millions and millions of accounts were made for customers who never asked for these accounts to be made for them, all in the name of hitting sales quotas. Don't you just hate salespeople? Come on, salespeople. Having failed to make amends, Sloan stepped aside, leaving interim CEO Alan Parker holding those stagecoach reins, trying to fix the business. Two of the leading candidates, PNC CEO William Demchok and former Bank Corp CEO Richard Davis, both declined to take on the role. And so the search continues into its fourth month. Parker has said the bank will be holding off on setting strategies and targets beyond this year until a new CEO is found, which is looking more like a fruitless search with each passing week. With the Fed set to meet on July 30th and 31st, we may be looking at a less positive environment for the banks in just a few days. If you are interested in the banks, you may want to wait a couple days and listen to the Fed meeting. But if you want to pull the trigger now, I'll still give you the go-ahead. Particularly on JPMorgan and Bank of America, I like those two more. While I don't think it would be a mistake to get into Wells Fargo, I just don't see a reason to get into Wells Fargo. All the banks are very cheap right now, and JPMorgan and Bank of America, as well as Citi, although we're not talking about Citi right now, are all great operators. They're better operators. I like it. I'd go with them. Hey guys, that's it for this recap. I put my portfolio up for full disclosure. Let me know what your thoughts are, if you agree, disagree, or if there are any other stocks you'd like me to check out. I appreciate all the likes and comments, and make sure you are subscribed to Investomania, brother.